Hello, this is a Chartprofit video, just under 2 hours into the session on Friday 27th of May. Looking here at the pre-open, the Emini S&P quick review. Controlling price of the current distribution is at 2041, remains there. That's this level here. We had one value area printed below that, which I think is a rejected test. That was Thursday 1 week ago. Subsequent to that, the Emini bounced back above that important level as described up here Monday 23rd of May, and market charts at that point had remained positive. We were hoping for the Emini to move higher from that point after that test. I said pre-open today that buyers have been active this week, and just pointed out these numbers here which represent net buying and net buying volume, and these numbers here in particular on the Tuesday plus 21 for the net buying, and this number here for the net volume on that day were particularly high, marked aggressive buying up here in green. As I said, we managed to auctioned the E-mini successfully higher. This level here at 2086, just below the previous 2 days value areas, was a previous level of resistance, a point of control up here at 2086. And I've said here, if the chart closes today, Friday, above 2092, which was Wednesday's high, it will indicate a bullish weekly structure for the first time since the end of March. I'm going to spend a little time concentrating on that E-mini. In my opinion, the best gauge of the market and its price action that there is. So we'll look closely at this. This is a daily chart. We're actually looking at the current chart right now for the S&P June. And we have here the two important levels. 2041 is the 9-month controlling price here that we've just looked at, and that is the controlling price of the current distribution that we're in, and therefore probably the most important level at the moment. And there's that dip or that test below that level. Sometimes the market needs to test below an important level, an important support, see if there's any sellers willing down there to auction the price lower. I didn't find any. We had a kind of a reasonably strong close that day, but the following day all the value areas were, for the next couple of days, printed above that level as we've just seen. But something happened earlier in the week when the major point of control, that's the overlaying or stack distribution at 2054.50, that is the major support, that's the major controlling price of the big picture, but the current distribution is at 2041. I showed this graphic a few weeks ago, 2 or 3 weeks ago, and I've added this comment here, and basically I suggested at that time that if the controlling price of the current distribution, which started down here somewhere, in fact I know exactly where it started, but I suggested that if that point of control, the controlling price, were to migrate, the two likeliest levels were 2028, 2056 here. So the possibility that time would come in at these levels, and if so, to my mind, that would have given the distribution, there would have been a sort of a complete look about it, and therefore it would quite possibly have been bearish. By that I mean the level that the thing started at, and if we were to finish at this high for this distribution, these two levels here would be a sensible, logical place for the point of control to emerge. Now that hasn't happened. What's happened instead is that 2041 here, the existing controlling price, has been very clearly support, and that maintains our development target to 2120. Again, that could change. But currently that's what I'm looking for. If price were to fall back and spend plenty of time at 2056, that would do the same job. But currently now I'm looking for development up to that level. Just quickly, here's the price action this week in an hourly chart here of the E-mini. Everything to the right of this line here is this week's price action, and basically what we saw was very clear support at 2041. I'm going to quickly look at the stock index charts. This is the spider, and as the major point of control migrated on the E-mini, it did so as well on the spider, and that level is now 205.40. And up here at 209.90 we have the previous major. It actually migrated down to that level, and what we are seeing, as you can see here, is price being capped top and bottom by those two levels. Now price up here, especially price action like this, would be bullish, but until we overcome that resistance at 209.90, spider could definitely have a problem with this level. This is IWM, the Russell 2000 ETF. The support on this chart is the halfway point of last year's high to the following low. And with the positive price action this week, we got back above that level, which we were following that as a key chart. That's a positive move, but we have big overhead resistance here at 115.35. That's the major. So the Russell's got some work to do to put itself in a strong position, and that would be up here. And we're looking here at the Qs, and as we've described in previous weeks, this major level at 105.13, which also corresponds to the halfway point of last year's high. Big level of support, and it did prove to be that. We kept saying that price under here would put the chart in a really weak position and be a general indication of weakness for the market, but we've held it really well here, and it's doing about the best it can to head higher. So that's a relatively strong chart right now. Looking here at the indicators that make up the breadth component on the S&P Pulse chart. So this is the market chart for New York, and breadth indicators for New York through Thursday. These two bottom indicators are the ones I use to give the breadth section of the Pulse chart. We'll look at that in a second. And they're both moving now above, these two, above the levels that I call supportive, coming off a reasonably oversold level here. And if we look at the Pulse chart for the S&P, there's lots of information on here. We ran into a little trouble on the breadth indicator here, where it went red, went back to neutral. We've just turned back to green here, and as you can see, I've mentioned that the price oscillator, the momentum was heading higher here, and we've just come through into green, in other words into positive. So this is looking quite a bit better on this Pulse chart here. And at the same time, the point of control, as we just mentioned, which was up here, the major at 209.90, moved down to this level earlier in the week. To some extent that diminishes the resistance at 209.90, because this is now the important level. So, and we've marked green here as well. So this is a much healthier, much more positive looking Pulse chart right now. We'll be wary to look out for any red on this chart, but right now in the longer term, as long as we hold above this level, 205.40, which is now time support, this looks much better. Very quick look at the FTSE 100 and the DAX. This is the UK's FTSE 100 chart. Relative to the important controlling prices, it's in a much better position than it was a week ago. We still have this natural overhead resistance here just above 6,300, which is the halfway point. I'm going to say, like the, I don't know, there's lots of charts like the IWM, there's some overhead resistance, and price above this resistance up here would put these charts in much stronger price locations. But going into next week, these charts seem to suggest that possibly we're not out of the woods yet, the difficult period. Let's hope to see price printing time like here on the FTSE above that level. And here for the DAX, similar sort of situation. The resistance is here, that natural halfway point resistance. This was really a positive when the DAX consolidated and found support at 97.40 on its major. And again, I just let you know that these levels have been right where they are on these charts for months. So this is really good support, and what this looks like is a higher low right now, and that can be a really bullish pattern. But with this resistance again here, just want to be aware that at some point, if the markets do rally higher, these will come into play on multiple charts. So what is the sentiment indicators telling us right now? Just move pretty swiftly through here. We spend a lot of time on the RIDEX, and just generally what we know is that the market has had a very good rally off the February low. But for instance, this indicator, the RIDEX assets ratio, or my version of it, has really not indicated much interest from the retail investor. In a contrarian way, that's quite encouraging. What we don't want to see is this indicator shooting higher with the market, but right now it's pretty subdued. Evidence being the bull fund assets, if we look at those in isolation, this level here representing the point where over the last few years bull fund assets below that level being an indication of over pessimism, and the market tends to rally. You can see that quite clearly on the chart. And bear fund assets, which had fallen, well, reached a peak up here at the low, which is what you'd expect, and then as the market has rallied, these bear fund assets have come off pretty quickly here in line with the market over the last 2 or 3 months, but across this period here, just over the last few weeks, they've picked up again. And the most surprising sentiment indicator of the week award goes to the public poll from AAII and the bulls percentage. Public asked to rate their expectation over the next 6 months for the market, bullish, bearish or neutral, and according to this survey, or certainly the bulls percentage, the public are less optimistic about the stock market now than they have been for nearly 11 years, because this week the bulls percentage was lower at 17.8%, and that's the lowest since 2005. I had to check the numbers. I have checked the numbers, and that's where we are. This is the investors' intelligence. I've pretty much skipped through this, not telling us anything right now too important, apart from just a few weeks ago, 5 weeks ago, so close to the top up here, 4-week moving average of the net bulls minus bears moved above this level, a previous peak for the indicator in here, and that was often, as I've said at the time, often an indicator that market participants are getting a little too bullish. And that black line has turned down again. As you can see, that 4-week moving average is not anywhere near a real extreme as it was down here, for instance, at the market low. So I'm thinking this is probably neutral, not giving us any more information than that at the moment. The exposure index, which measures current equity exposure of active money managers, was higher again this week at 64.67. It was up from 49.55 just 2 weeks ago. Just in this little period here, down to just a couple of weeks ago, their exposure fell pretty quickly. Again, neutral reading I think at the moment. Seems to be an indication on one or two of these indicators, like the RIDEX, like the public poll that we've just seen. It just looks like the investors, or the retail investors, are just getting a little tired, or more than a little tired, of the market, which has pretty much gone nowhere for quite a long time. I mean, we've ended up going nowhere. We've had some real scares in here. We're all in a bear market down here apparently, but we're pretty much back where we were. And I think there's just this kind of, what's the word, ennui, just lack of enthusiasm, as evidenced by this 4-week flow number here for the Lipper US fund flows that I record every week. This week, equity funds, including ETF outflows, were a negative 4.8 billion, and the 4-week flow number came in at a negative 26. That's this level here, and this is certainly getting down to the levels that we saw down here and here, recorded at the previous 2 market lows there. So it's kind of like the RIDEX. It's interesting that this is happening with the market really rallying hard off that low in February. I mentioned right at the top that the weekly price structure, or the weekly structure of the S&P, could give an indication of buyers active this week if we close above Wednesday's high, which we could well do. I split the weeks down into sections like this each week in the ebook, and this is through last Friday here. It's very simple, and then I just classify each week as sellers active, buyers active, or no bias, and then we look at something called effective or ineffective buying on that time frame. It's very simple to do, but you can see, looking back over this many weeks here, for instance, we've seen a lot of sort of non-directional commitment. I call those no bias. And this week here we had sellers active, and this week over here sellers are active but ineffective. In other words, we closed down here below Monday to Wednesday's low, which is here, but actually if you imagine this is a weekly bar, it was actually higher, overlapping higher than the previous week. So although the sellers were active across that week, they were ineffective. This week we've had a no bias week, and there's a possibility this week we will see, by the time I publish the ebook, whether we have effective buying on the weekly time frame. Okay, this is the United States Oil Fund. Recently the 6-month controlling price moved to 1078, and then we came higher off there. When a point of control moves on these longer time frames, I've found that what you want to do is look, as it migrates, you then look for the direction immediately after that event, and that was clearly higher on this bar here. So we're moving higher, and this is a market that has been very correlated to the stock market for a while. So the fact that oil is moving higher and hitting multi-month highs as it did this week is probably a positive sign for the market. Looking at TLT, the Treasury Bond ETF, and price relative to this level, 130.77, which is where the 8-month migrated to quite recently. It comes in here and price below that level. We are currently consolidating underneath that, which isn't that is not a bullish pattern. So unless that point of control migrates lower, it's key resistance. I'm not interested in the long side of this chart until either we see price back above that level, or if we saw a decline down to this important halfway point, and then we saw a bounce with the oscillators and those sort of things, confirming maybe some positive divergence there on those sort of basic technicals. To sum that up, I wouldn't be interested in the long side of the market. So either this time up here or a low here, which looks confirmed. Dollar index, we've said over the last few weeks, price relative to the 2-year at 94.79 is the most important thing to consider. And as long as we're above that level, and we happen to be consolidating above that level at the moment, just a little hint of a higher low here. This is strong price location, and again, unless that point of control migrates, which it hasn't yet, I'd say the dollar here was in a pretty strong position. So we've got the oil chart going up, and at the moment we've got the dollar index here heading a little higher. Usually they move inversely. It's going to be interesting to see how this plays out. We see a lot of strength in this chart in the dollar generally. Could upset the oil, price of oil, possibly the market as well. So let's just look at the other side of the dollar here on the Euro FX chart, and as if to confirm that we're currently printing, we broke below that important support, the 3-year at 111.98, and there's a little consolidation going on here. There is support for this chart, just a little lower, as we mentioned last week, and we'll monitor that level in the pre-open each day, because price down here would be very weak. So we may get some support here, but currently not interested in the long side until we print some time back above that 3-year. So sort of confirming strength in the dollar here. Okay, that concludes this video, this week's summary. Once again, I wish you a good weekend and thank you for watching.